The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Happy Tuesday, everybody. We got a great show planned for you, but real quick, I want to thank last week's guest, Kevin Lane. We got a lot of calls and emails thanking us for our updates on the markets, and I know a lot of you are really concerned about whether the next bubble is going to burst, and I think we covered that topic in depth. Today's topic, we're going to switch gears a little bit this week, and we're going to talk a little bit about 401ks, something that I focus my practice on, and I've told you about many times. And I'm joined by an expert in the industry, as always. But today I'm really proud to introduce Quincy Faison to you. But we'll give you a quick bio on Quincy, and then we're going to get right into the program. He's currently the chairman of a company called American Wealth. And the company is, and he's also, chief editor of a magazine called American Wealth. But American Wealth is a third-party administrator and record keeper of small business retirement plans. And they're based here in South Florida. Prior to that, he was the founder of NetCirc Technologies, which was a multi-million-dollar business and was one of the first SAP Business One resellers in the United States. He later sold it to a large SAP Business One retailer. He's been a very successful executive at IBM for many years. He currently lives in Weston, Florida, with his wife, Kristen, two sons, Jordan and Dylan, and is involved in many successful charities. Last thing I can point out, he was a wrestler at Bucknell University. I mean, maybe we'll ask him a couple questions about that. But without further ado, I'd like to welcome Quincy Faison to the program. Good morning, Quincy.
Good morning, Peter. Thanks for having me.
Yeah, my pleasure. So one of the things that you and I talk about a lot is 401k plans. And there's been a pretty large transition in the 401k markets. And I really like to talk about 401ks a lot because people worry about the stock markets going up and down, but 401k plans seem to rebound faster than anything. And I think the biggest reason is because people continue to put money into it every 2 weeks. But dating back to July of 2012, there was a pretty large piece of legislation that was enacted called the ERISA 408b2, and it basically relates to fee disclosure. And I'm wondering how you've seen the markets in the 401k space change as a result of that fee disclosure enactment.
Yeah, that's a very good question. We've seen a lot of players who have decided to exit the market due to those disclosures. And what it's doing is making our plan sponsors and small business owners more intelligent shoppers. Having to disclose the fees that they're paying that no longer can be hidden, it's a big thing, right? Fee disclosure is something that is not going away. I think that we're going to see the regulatory agents or agencies get a lot tighter when it comes to the enforcement of the regulation of the fee disclosure. So for us, it's really been a great thing, and the educated shopper is a good shopper and is a good customer.
Yeah, I agree with you. I mean, I think it has been a good thing in that it's really weeded out the people that shouldn't be in the business against those that should. Before I go deeper into that, though, Quincy, this question comes up a lot. And I mentioned in your bio that you're both a third-party administrator and a record keeper of small business retirement plans. Can you tell the listeners briefly what the difference between the two, TPA and record keeper, are?
Yeah, absolutely. So TPA, the third-party administrator, is really their primary role is to ensure that the retirement account meets the IRS regulations. So when I look at all the different components to running a 401k. Obviously, we've got the ERISA attorneys that really make sure that the plan maintains the qualification under the Internal Revenue Code. You got the investment advisor who makes sure that the investments in the plan are proper. But with the TPA is really the glue that holds the retirement plan together. So responsible for the day-to-day administration of the plan, including distributions, discrimination testing, asset reconciliation, and government filings such as the 5500. A record keeper is really responsible for who owns what. Right. So when there are contributions made at the plan level, from a custodian standpoint, the custodian knows exactly what the plan owns. That record keeper is able to dissect those contributions and actually tell you what pro rata share each employee has, which is very important, obviously, when it comes to providing a compliant 401k plan. And other things outside of distribution processing that a record keeper might do, some of the participant statements, processing some of the loans and hardship processing, giving access to the information via a web portal. Typically, we see record keepers have both plan participants as well as plan sponsor portal access to kind of see where the assets are.
Yeah, thank you for that. And that clarification is pretty interesting because a lot of people really don't know the difference. And a lot of my clients in the 401k space tend to call me and ask me questions about distributions and how the assets are divvied up and so forth. And that's really a role that I don't want, but it's something that you're really, really good at. The second thing, we're talking, going back now to this fee disclosure rule, I've seen some dramatic changes in plans, particularly in that I've seen plans that really nothing's been done for years. The funds have never changed. The participants have never really made any profit. Have you seen some of these kind of dormant plans come across your desk more so now as a result of the change in legislation?
Yeah, absolutely. We see a lot of these dormant 401k plans that have not been serviced by the current provider. Typically is more the larger providers that got into the 401k space, more of, I would say, kind of a factory or a cookie cutter type model, and there was really no hands-on service provided to the end user, the participant, and the plan sponsor. So what we see a lot is frustration. In the fact that now they've got to go through the fee disclosure, understanding what they're paying, and now they realize that they're paying for a service that might not be delivered. So there are a lot of plans that are coming available that are out looking for new 401k providers that can provide that service. At the end of the day, it's really about documenting what you're paying for and making sure that the fees are going to be reasonable for the services that you're getting.
And how are you finding the actual trustees of the 401k plans to be today? Are they understanding of the rules and regulations, or are you finding that you're having to educate them as to what they really should know?
Yeah, we're actually having to educate a lot of the plan sponsors or the trustees as to what the fee disclosures are, how often they're supposed to distribute to the plan participants, and kind of make sense out of those fees because, it's convoluted. When you look at how things are priced in the mutual fund world, how things are priced in the administration world, and then how things are priced in the record-keeping world. So providing that education is part of a sales process that we go through with our clients so they understand exactly what it is that they're paying for. And obviously it needs to be black and white that the layman person can really understand.
Yeah, and in thinking about that, there's so much jargon in our industry with regards to 401k plans. I tend to see that the vast majority of the trustees just don't want to be, they just don't want any headaches or hassles. And so they just basically put a plan together just to say they have one. But it doesn't really deliver what it should ultimately to the end user.
Yep. And we see that a lot, especially in the small business world. When a company starts to grow and the revenues grow and there's enough funds to be able to provide this benefit for the plan participants or the employees, we see it all the time. They create a plan and it's more of a set it and forget it. And as you know, with all the regulatory changes that are coming about in the industry for that very reason, now are putting the operation of the 401k plan to the forefront. So now I won't say it's complex for the end users, but they're realizing that there's more involved than just creating this benefit. This is not like, providing health insurance. It's a more active involvement from the company itself.
And I'm also finding, and help me with this as well, but I'm also finding that a typical plan doesn't want to rock the boat or make any changes. Are you seeing that as well?
As far as investments?
Either investments and or changing the provider because it's just too much heavy lifting.
Yeah, absolutely. We're seeing a lot of that. It's easy to stay the course and just keep going forward and not have to get involved in asset conversion, getting to know your new TPA or your new administrator, your new record keeper. And so what we're doing from our standpoint, we're trying to make the conversion process or the sales process a lot easier for the client. So as we mentioned earlier in the show, the education process about fee disclosures goes well beyond just fee disclosure. It's educating the process of, how are you really supposed to be operating a 401k plan? And what we found, or what we see a lot, is in the smaller plans that are less than $5 million, there's a lack of education or understanding of the true operating of a plan from their responsibilities. Where in the larger plans, which are the 25 and over, we see a more active role from the plan sponsor and the leadership team.
Yeah, and typically your plan, your typical client is under that $5 million space?
Absolutely. So we focus on from a startup plan to $5 million in assets because we believe that is a market that's been underserved, and they're looking and yearning for a service provider to provide the service for the fees they're paying. So for us, it's a great time to be active in that particular market.
Yeah, I would tend to agree. The next thing I was going to talk to you about, and we're going to take a short break in just a moment. But before we do, I want you to think about this a little bit, Quincy. I want to get into a brief discussion, and you and I talked about this in the past, active versus passive management. I want to get into a little bit on the static sort of vanguard funds that are your basically your indexes versus using an active manager in the role that they play inside of a 401k plan. I realize they cost more, but I want to have that discussion. And we're going to have that in just a minute. You're listening to the In Black and Weitz program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I am your host, Peter Weitz. You're listening to the Black and Weitz radio program. Quick shout out to our sponsors, American Century Investments and the law firm of Retzel and Andrus. Also, I want to make sure I invite you all to follow me on my blog at In Black and Weitz. I'm going to be posting some interesting statistics about today's show in regards to 401k plans after the program ends. You can also follow us on your iPhone and on your smartphones through the Voice America business icon or iTunes library where you can pick up past shows. Last thing, two things, housekeeping, Facebook, follow our program, and I'm available on LinkedIn at Peter Weitz. So anyway, we're joined today, as I mentioned earlier on the show, by Quincy Faison, who's the president and chairman of American Wealth, a really large record keeper in TPA in the small business market space, which is 401k plans of $5 million or less. And right before the program, I introduced the next segment to Quincy to give him a little bit more time to think about it, because I know that this is going to be a pretty lengthy conversation. But it relates to the investments inside of a 401k plan. And really, as it relates to talk about fee disclosure and what stuff costs, there's been a really large pushback from the typical 401k plan sponsor, the trustee, in that they're always driven by fees. And they don't necessarily want higher cost mutual funds. They always want the indexes because they seem to cost less. But I mentioned to Quincy at the break, we've done an exhaustive analysis here of how mutual funds net of fees can outperform the indexes. And so I'm a big proponent of active management. Now, Quincy, I want to hear your thoughts on active versus passive management.
Yeah, absolutely. So for the listeners who might not be aware, obviously the difference between active and passive, active managers are really looking for those stocks that are undervalued and expected to grow, and they'll manage those selections to try to outperform benchmarks over a period of time. Where from a passive standpoint is really trying to match a particular index by owning a large investments of a certain benchmark and trying to really stay the course. For us, as you know, we really enjoy active versus passive, given the fact that the market can change at any given time. The other side from a passive standpoint is that passive managers are paid given the performance of a certain index. So if that index was to fall by 15% and the manager was to fall by 10%, that fund manager is still getting compensated because he's actually beat his index. Well, what our customers have told us and have shown over the past is they've got one goal, and that goal is don't lose my money. So from an active standpoint, because it's more frequently from a trading standpoint, we really enjoy that because our customers don't want to lose money.
And I appreciate that. And I think one of the comments I hear a lot when I'm out there on the don't lose money piece is also, people get trigger happy in the marketplace. And what people don't realize about indexes is that there's no place to hide when an index is going down. And so if that index tends to drop, it's going to drop. There's no one managing what happens to that free fall. It's just when the free fall ends, that's where you end up. And active managers can actually cut their losses and get out of an investment versus a passive manager because they have that ability to go to cash. And I think that's a huge distinction. One of the things, though, that you and I talk about a lot, Quincy, is that there are also managers out there that are able to protect the downside. They're able to manage for when the markets go down. And I'm wondering if you can comment a little bit about that.
Yeah, absolutely. So when you look at downside protection, some of the key drivers of the long-term performance is really two things, right? Avoiding major drawdowns and then actually participating in the markets from a long-term growth standpoint. So ultimately, we always hear in the 401k world, it's about asset class diversification, right? So when we talk to our participants and we're putting plan assets in place, it's always about diversifying the assets. What we found is asset diversification does not necessarily equal downside risk management, especially when we're talking about declining markets. Just like you said, in an active environment, they've got the ability to go to cash, versus on the passive side, it's kind of stay the course, ride the wave, and then try to participate when the wave's going back up. Plan participants really define risk as absolute loss and not necessarily standard deviation. So as we talked about, how much can I lose? Will I have enough to retire? Those are the two main things from a participant standpoint. So if we look at the year 2010. The average target date fund lost 1/3 of its value in 2007 to 2009 market drop. The average 401k balance dropped 30% from $65,000 to $45,000 in 2008, and 60% of the CFOs wanted target date funds to avoid protection against that market volatility. Well, as we know from an active standpoint, two things will really tell you where a stock is going to go. One is going to be price, and the second one is going to be volatility. Things that change price and volatility will make up where that stock is eventually going and heading.
And by having those people on board and having those managers in place, you're able to preserve the wealth that's generated along the way. And I think that's critical for people to understand. So having somebody watch your investments for you is really what the goal of an active manager is versus having to watch it yourself. And, I think you and I can both agree that there aren't enough good investors out there that don't know this or that even know this industry that can watch this stuff on a day in and day out basis.
That's absolutely right. And more importantly, you want investors that, especially in the retirement plan market, are not using any derivatives, leveraging, or shorting. One example of one of our providers that we use a lot in our plans is F Squared. They're Alpha Sector. If you look at the Alpha Sector fund in bull and normal markets, they are equally invested into 9 industries. So from energy, healthcare, industrials, materials, technology, utilities, financials, consumer staples, and then discretionary. So each one of those industries in bull and normal markets have an equal concentration of 11%. If the market starts to go and we start to experience adverse equity markets, they've got the ability to invest more in one sector than the other. So we might have 50% in one sector and 25% in the others. And they also have the ability to move all to cash. And now this is done real time. We're talking on a weekly basis, so we're not waiting quarterly. We're monitoring and seeing what's going on a weekly basis, and using some proprietary monitoring tools. They have the ability to turn industries on and turn industries off, and obviously convert to cash equivalents in down markets.
And that is certainly something that's going to preserve the wealth of the people using this plan properly. I saw a statistic the other day, Quincy, and it said that in order to have a successful amount of money in retirement, or to replace your income that you earned while you're working, people need to save 10% of their salaries per year. What are you finding, or what do you see people are saving now as opposed to what they should be saving on average?
Yeah, so on average, what we're seeing is our plan participants are probably around 6%. And so what we're trying to do is we're trying to get them to that 10% clip. And that is done obviously through the use of planning tools, education, and ultimately having the right financial advisor that is not only advising the plan but also working with the participants to understand how they can manage their individual cash flow to be able to create more savings for their retirement.
Yeah, and I think that's absolutely the case. I mean, I'm finding that when I'm seeing a lot of, and I really don't like this for people's future, is I find a plan where the employer has a 3% match. And participant will say, okay, I'm going to put away 3%. My employer is going to give me 3%. My money's going to double, but I'm just going to leave it in cash, and therefore I don't win or lose, but I've doubled my money. And what they don't realize is that's not going to add up to enough in retirement.
Absolutely.
And so what sort of education are you providing that gives these people the thought process to make them rethink the way they invest their money and how their money grows?
Right. So there's actually what we see is 2 levels of education that needs to be provided to participants. One that we provide, which is more driven from managing cash flow. We've partnered with Dave Ramsey's Core Financial Wellness, and each one of our participants has access to taking this course. And what we found was it was not really the education on asset classes, diversification, or standard deviation. The participants really needed education on how do I manage my monthly cash flow. And they also needed the tools to be able to manage that monthly cash flow. You can't save what you don't have, is kind of what we say here around the office. So we really focus on where are some of those areas that we consider low-hanging fruit in their own personal P&Ls, and we try to eliminate those or convert them over to a savings vehicle. What we found with our participants, the first 90 days that we actually start focusing on cash flow, that we're seeing $2,700 savings in the first 90 days. On top of that savings, we're seeing another $5,300 in debt reduction. So the equivalent is about a $9,000 swing for our participants. What that means is they now have more money to get to that 10%, 11%, or 12%, and understanding how do I get there and how do I maintain. You know, one of the things that we're never taught in high school and college is how much should I be paying for my house? How much should I be saving? And we're able to provide that type of education to our participants. And then our financial advisors are able to actually give more education as it relates to the asset class, diversification, where should I be putting my money when I'm saving.
Yeah, and a couple weeks ago I had on the program an expert from American Century Investments, and they did a study of current workers in the workplace that are over the age of 55, and in most cases over the age of 65, but are still working. And it was sort of, if I knew then what I know now, and I think it came down to the fact that they're still working because they didn't put away enough for retirement. And one of the questions that always comes up, or one of the sort of the reasons why people say they can't save, is because they live check to check and they just don't make enough. What do you say to those people?
Yeah, so it's not necessarily that you don't make enough. It is you're spending too much. We've always been taught a philosophy of finance that might not be applicable to the average employee. So we were taught to go buy a house. We were taught to go get a nice car, get a good white picket fence, and you're happy. What we've seen in the market, obviously, is you've got mortgage brokers who are trying to get people into houses a lot bigger than they can afford, which is what we saw in 2008. So really just understanding some of those percentages and how much should I be spending on certain things will allow people to start living within their means, which is the ultimate goal, right? The ultimate goal is not to go out and have a fancy car if that's something you can't afford. The ultimate goal is being able to prepare for retirement when you're not able to earn as much as you can earn now in your working years because of old age, disabilities, et cetera. So it's really about bringing the conversation back to how do I live within the means that have been given to me.
Yeah, and we used a great example where we said that if you want to lose weight, the first thing you need to do is count the calories of the food that you eat. And I tell people all the time, take 1 month and keep track of every single dollar you spend for an entire month, and you'd be absolutely amazed at where your money goes. And truly, everybody's beyond amazed when they actually see what they spend money on. I think once you know that, it becomes a lot easier to figure out where you can cut stuff out and save, akin to going on a diet to lose weight.
Absolutely.
Yeah, the last thing I want to talk about in that regard, or I want to change gears a little bit, and we'll probably cross into another break when we talk about this. But there's been a lot of administrative fines and penalties administered by the Department of Labor as it relates to 401k plans. And I don't know that those fines are necessarily I think they're inadvertent. I think it's more driven because the plan trustee simply just doesn't know what to do. However, there's still a huge amount of fines that were levied last year, and I'm sure even more this year. Tell me real quickly, and we're going to get into this, and we'll probably take a break in between, but there's an ERISA Rule 316. Can you tell me what that is by definition? And then we're going to talk about how it actually can help eliminate some of those penalties and fines. Yeah,
absolutely. So the plan administrator of a qualified retirement plan is defined in ERISA Section 316. Not to be confused, the plan administrator is not to be confused with a pension administrator or a third-party administrator. And so in that regard, the 316 has got to follow some primary responsibilities, which is ensuring that all filings with the federal government, Form 5500, et cetera, are timely made, makes important disclosures to the plan participants. We talked about some of the 408 fee disclosure, hires service providers if there's no other fiduciary that has certain responsibilities, and obviously following the plan document. So, and we didn't talk about on this show, and I'm sure you probably talked about on others, there are certain types of fiduciaries that are involved in a 401k plan. There's a 321 fiduciary, there's a 338 fiduciary. Those two fiduciaries relate to the selection and monitoring of the plan. A 316 fiduciary is actually the operation of the plan and the plan operations. So it gives the ability for a plan sponsor or a small business owner to basically outsource the risk of operating a plan to a service provider such as us or others that are out there.
And that's cool. We're going to talk a little bit about that, or more at length about that, when we get back from the break. You're listening to the In Black and Weitz program, radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program with your host, Peter Weitz. You're listening to the In Black and Weitz radio program. And we're joined today by Quincy Faison, who is the president and chairman of American Wealth, a large third-party administrator and record keeper. And prior to the break, we were talking about some of the roles that can be assumed by a record keeper, administrator, and or financial advisor to take some of the responsibility and some of the headaches away from the plan trustee. And I want to read to you from the Department of Labor website, a press release that came out, just because it kind of is a good lead into the next segment of what we're going to talk about. It says the Department of Labor is overflowing with cases of regulators taking action against employers accused of mishandling employee benefit plans. Among the most common cases are errors in administering 401k plans. Although the Labor Department officials and experts in the ERISA field say the majority of cases are errors in reporting and do not necessarily result in civil lawsuits, the number of benefit plan cases investigated are still impressive. The Department of Labor closed 3,677 investigations in 2013, with nearly 73% of those resulting in monetary fines or other corrective actions. Lawsuits were only filed in 111 of those cases. And I think this speaks to what I wanted to talk about next, Quincy, in that is, what is the role of a 316 administrator, and sort of what are those administrative tasks that could potentially pose problems for a plan trustee and ultimately lead to fines and or corrective action?
Absolutely. So first I want to start off by saying that a third-party administrator that's retained by a plan is typically neither a 316 administrator nor a fiduciary. Some TPAs will accept that appointment as a 316, but plan sponsors should not assume that just because they are using a TPA, that TPA has actually accepted those 316 responsibilities. So an administrator is responsible for managing the day-to-day operations of the plan. And those duties are set forth by ERISA, and the terms of those duties are solidified in the plan document. So some of those responsibilities of a 3 to 16 administrator would be to act as a named fiduciary under ERISA, determine the eligibility of employees that participate in the plan on a payroll-by-payroll basis, maintain all the necessary records, being able to interpret, plan, and publish rules to those participants, all of the government filings, so filing the 5500s, the 8955s, being able to procure fidelity bonds on every person that is related and involved into the plan, providing all the participant notices, so including tax notices, enrollment kits, fee disclosure notices, reviewing and improving some of the financial reports and investment reviews that the investment advisors are having on a quarterly basis, making sure there's a funding policy established, making findings of fact, so interpreting some of the new regulatory changes from an Department of Labor standpoint, and obviously providing participant statements. Those are just a few of those daily operation type activities that a 316 would accept on behalf of a plan sponsor or a business owner, which is extremely important because at the end of the day, the business owner wants to focus on his business. He does not want to be in the business of running a 401k plan. And so outsourcing those responsibilities, the fiduciary responsibilities, to someone who's qualified will allow you to minimize a lot of those penalties and fees that we see a lot of small business plans are getting exercised. And it really just makes for a clean, smooth plan and allows the owners to focus on what's core to them and allows an expert in the industry to focus on all the compliance and daily operation of a plan.
Yeah, and that's so I'm sitting here and I'm trying to absorb everything that you just said. And essentially what you're saying is all of the tasks that you just outlined are tasks that a plan sponsor, somebody who actually works for the company and acts in the interest of the 401k plan, is responsible for. Is that correct?
Absolutely.
And so by having this 316 designated third-party administrator, those tasks essentially are taken away from the company and put more into the hands of an expert like yourself that actually knows what to do and when to do it.
That is exactly right. And you know, I always sum it up in this. A good TPA, their role is to make sure that the 401k plan for their clients are meeting the expectations of the Department of Labor. You know, plain and simple. That is what a good TPA will do. In making sure that you stay compliant, that you still have the tax qualification of the plan, and that allows the business owner and the plan sponsor to focus on their core business.
Yeah, and so I guess what I'm confused about is why wouldn't every plan consider this?
You know, it goes back to what we mentioned earlier in the show. It's just a little bit about education. A lot of plan sponsors assume that because you're working with another 401k provider, that those responsibilities are offset to the TPA. And unless you have the 316 agreement in writing, the plan sponsor is still ultimately responsible for the operation of the plan. So what we see is that a lot of the providers that are providing the more cookie-cutter structure of 401k plans, they're providing a tool that allows an administrator or a plan sponsor to manage that plan. But there's the gray area of the responsibility. So it's really important that plan sponsors and business owners understand what's available to them and know, what's important to being able to outsource from a 316 standpoint.
Right, and I just for me, and I know cost obviously drives the bus and everything that we do, I don't necessarily see how this could be cost prohibitive because of the amount of responsibility that you're taking down, particularly if you're on the hook and as opposed to a company when it comes to a fine.
Absolutely.
So that's just, I just wanted to touch base on that because it's amazing to me that, somebody would actually consider not taking on or not passing the baton to someone that actually understands what to do. So, we talked a little bit about fees. We talked a little bit about the investments inside of a 401k plan. We've talked a little bit about some of the roles and responsibilities that can be offloaded, if you will, from a 401k plan. But I kind of want to talk just briefly about changing the plan itself. And we brought it up a little bit in the beginning of the program that, if it ain't broke, don't fix it. And, I don't want to have to actually do something, that inertia with having to do something. So as a result, I'm just going to stay the course and keep it the way it is. But I want to walk through briefly what changing a 401k plan actually looks like and how it's really not as complicated as people think. So let's just start the process of with just timing. How long does it take to convert from start to finish a 401k plan from one vendor to another?
Right. So that's there's two elements to the question. One is how soon can we be up and running and trading on a new platform, a new 401k platform, and that's as little as 1 to 2 weeks. The overall conversion process is typically about a 6-week process when you talk about liquidating and moving the assets over to the new custodian and the new 401k platform. So the number that I always use for our clients is it typically will take you 1 to 2 weeks to begin with a new 401k platform.
And I guess the question is, how much heavy lifting does a company have to do to convert the plan? Or is all that done by the providers that are selected?
Right. So that is a great question. 95% of those activities are done by the provider that's selected. So it's very transparent to the plan sponsor or business owner as to kind of everything that's going on behind the scenes to be able to move the assets over to the new custodian and, start trading those assets.
Right. And that's the crux of this. So I guess to simplify, there's really not a lot to do from the plan side or from the people that work for the company side. There's really more on the shoulders of us, the providers.
Absolutely.
And with that, it's really not as difficult as people think. They just, again, it has to go back to that education of really letting them know what they need to do and what they really don't have to do.
Absolutely. And a good provider is going to be a quarterback for that organization. He's going to let them know exactly what documents they need to sign from the custodian they're leaving and the 401k plan they're leaving and moving to, and just being there every step of the way to guide them through the process. Those activities that don't require the involvement of a plan sponsor, then they're not involved. And so it's very, very, very transparent to the end user when they're converting these assets.
And it almost makes sense that if the plan sponsor doesn't know what they need to do, they're probably not getting the proper level of service from their current provider anyway.
Absolutely.
And I know we're seeing a lot of that. Quincy, we're going to take a quick break. We come back. I got a couple of other questions to ask you, but I'm not going to tell you ahead of time what they are. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions calculations using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. My name is Peter Weitz. You're listening to the In Black and Weitz radio program on Voice America Business. Make sure you follow my blog at In Black and Weitz, or make sure you follow my Twitter account at Peter Weitz. I've been tweeting some interesting comments that my guest Quincy Faison has made today throughout the program regarding 401k plans. And prior to the break, we were talking about the relative ease of converting a 401k plan from one provider to another. And I know, Quincy, I had to cut you off for the break, but you were making a comment during the break, and I guess you had one other point in that regard that you wanted to make.
Yeah, absolutely. So the biggest thing to talk about when we look at converting from one plan to the other is, while the overall process might be a 6-week process, the time from converting to actually being able to access new funds are typically 1 to 2 weeks. So it's not as long as one would typically think as far as the I would call the blackout time between one plan provider to the other. It's a very short process.
Yeah, because you can basically get the new plan up and running and get payroll going into the new plan before the assets of the old plan move into the new plan. Is that essentially what you're saying?
That is exactly correct.
Yeah, cool. And I agree with that. It really does not take a lot. And, that sort of segues into the last part of this I want to talk about. And, the 401k space, like everything else, has been blessed with the ability to automate. And I don't think nearly things are as complicated as they used to be, because everything we do now is really web-based. And what you're finding, and I'm finding more, is that payroll companies, or at least the top names that we know of in the payroll, used to have a stronghold on the market because they would be able to sync payroll and 401k plans and movement of those dollars back and forth. However, there are so many other companies out there now that provide payroll services that sync with the 401k trustees, the third-party administrators, et cetera, that synchronization is kind of a thing of the past. And in that regard, there are so many things that can be done now. And if I know on your website, for example, you can essentially build your own 401k plan right on your website.
Absolutely. So we allow the automation tools, especially for some of our smaller clients, that they can actually go out and configure a plan design on our website. So it typically takes a business owner about 30 minutes, and from the time of starting the plan design to finishing the plan design. And we've got live chat features that allows someone online to chat with one of our administrators as they're going through the process to understand what some of the terminology is, how it might benefit them, and actually help them understand how can they provide the benefit to their employees and at the same time maximize the contribution from a business owner perspective.
Yeah, and I guess in that regard, what are some of the features, what are some of the benefits that a user, an end user, a participant 401k plan is going to get from all the automation, and use your website as an example. So as an administrator and I'm a participant, I go into the website, I want to look up my account. What are some of the new tools that you're seeing from an automation perspective that are beneficial to the end user?
Absolutely. So they have the ability to log in to their account. They have the ability to make trades within the assets that are available in the plan. They're able to change their contribution. It really is a 100% self-service type of web application that puts the 401k back in the control of the participants. We've even got mobile applications that allow the participant to access their 401k plan through an iPhone or an Android device, and you'll be able to make, like I said before, contribution changes. They can increase. They can go from a percentage to a dollar amount. They can sell off one asset. They can buy additional assets. So it really is a self-service tool that our participants are really enjoying, that they have that control over their retirement. As well, we have the ability for the participant to see where they're going to fall within retirement based upon their current contribution, being able to see what their shortfall is and how can they fix that shortfall. I mean, as we know, I think the rule of thumb is you will need 80% of your current salary during your retirement years, and our automated tool will always give that visibility to the participants to see where they're at.
And that was what I guess goes back to that whole conversation you and I had regarding education. And I think that the tools that are available on the web, particularly from the end user, are really going to drive more of that education and get the participants thinking into how they're going to be able to save more.
Yeah, absolutely. We actually have another tool that we provide to our participants. It's a tool called Guide Financial, that it will actually connect to over 19,000 financial institutions so that it brings in real-time spending for a participant. And as we talked earlier, take 1 month and figure out where every dollar is going. This tool then allows for the participant to set goals of increasing savings or decreasing some of the debt that might be on their balance sheet, and then it has alerts and allows them to communicate with their financial advisor in a soft touch type of format. That is exactly what our participants require and have been asking for. So we're very fortunate and happy that we're able to provide that tool for all of our participants.
Yeah, and that's, again, comes back to this whole industry now becoming really service driven. And so really, instead of just bean counting the dollars in and dollars out as your role of a record keeper and administering, who takes a loan and who gets a distribution, you're actually providing more information to help them save more.
Absolutely. And as you saw, the 401k industry really got a black eye back in 2008 and 2009 when we had the market downturn. And then the fee disclosures, now people are really understanding it's not about just collecting assets. It's really about making sure that participants are retirement ready when retirement comes about.
And so let's just go back to this Guide Financial. So basically someone can go into that program, which is available through your website, and they can type in their bills. So you said it's linked to 19,000 financial institutions. How does that work?
Absolutely. So when they log in, they would actually go in and they will put what financial institution they currently are banking with, and it will ask them a couple questions. There's some verification process to make sure that they are who they are when we connect to the bank. A lot of times it's driven off of an online user ID and password from their current financial institution. And so once that happens, it automatically will download all of the daily transactions that happen within that particular account. The system then will categorize the spending based upon information that we gather. And so they have a nice picture every month of every single dollar that goes inside of their bank account or actually goes out of their bank account as to where it's going. If it's not categorized, it gives the end user or the participant the ability to categorize each dollar spent. And then that's how we get the level baseline for the improvements, right, for losing weight, if you will, right, getting rid of the debt and increasing some of the savings.
And that's key. Quincy, I can't thank you enough. And before I call it a day, I just want to make sure that people out there are aware of your website in case they want to see some of the tools that we talked about today. It's American-Wealth.com. You can read more about Quincy services and read more about Guide Financial as we discussed and some of the other tools that are available. But Quincy, again, thanks for being on the show. Obviously an industry that's very important to me in my practice, but anytime I have guests of your stature, I always end up learning so much more.
Well, thanks for having me, Peter. I really enjoyed it.
Yeah, and I appreciate that. Thank you. Next week on the program, we've got a really interesting show that I know all of you are going to listen to. There's over 3,000 different tax credits that are available for employers out in the country. And the question is, how do you know which ones apply to you? And then these, when I say tax credits, these are dollar-for-dollar credits against your income tax. So we're going to have on the program a gentleman to put together all 3,000 tax credits into a formula and into a program that he owns. And basically, by just telling them your workforce, he's able to tell you how much money you get to save in taxes. And I know anybody that's looking to save is going to be interested in that. So that's going to be a great show. Again, thanks to Quincy Faison from American Wealth for being my guest. Once again, it was a great program, and I look forward to you all listening next week. You're listening to the Black and Weitz radio program. I'm your host, Peter Weitz. Make a great week. Thank you.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.